Hi everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. In my last video I said that gold would be one of the best assets in 2024. Well, what has gold done? It's a bit flat for January, but it's actually up. So let's see what we got today. We have a new data point on the Gold Forecaster Index. Let's see. So this is a leading indicator. Using leading indicators, we can forecast the gold price 2 months in advance. As you can see here, the red chart is pointing up, but I see that lately for December we have a down dip, but the trend is still up. Yeah, it looks like we still need to be patient for this line to go in a plus. So there could be some downside risk in February. The yellow roll rate is actually not that good. It's trending down, but we are still in the positive. So as long as it's positive, gold will probably go up. When it's negative, then you can see that gold is underperforming. But okay, we're still in a positive. Let's see how that goes. Misery index is bottoming out, so that could be interesting. If this starts to move up with higher unemployment rate and higher inflation, that could be positive for gold. Real output is improving, so that's not good for gold. But yeah, the AI is increasing productivity. So yeah, let's see how that goes. This is not that good for gold. Let's look at production in Chile and Peru, which is important for silver. And that doesn't look good. Chile copper production at highs. So that means more silver production, and Peru also at all-time highs. So this could mean there is a lot of silver supply coming. And we have seen that silver is not doing that well. Gold has been doing better. GLD stock levels are at lows again, but you can see that gold price is having a lot of strength. So what if this trend reverses, then gold could break all-time highs. Okay, so that looks pretty good. COMEX numbers still going down. We need to see this bottom out. Could be some more downsides. LBMA, yeah, a bit of a bounce here. Let's see. This should move up for gold to move higher. Yeah, this is an important chart. In January of 2024, we have seen the second highest gold demand from China. That's this block here. That means that the Chinese actually think that gold is a good buy, otherwise they wouldn't buy that much. You can also see that here. These are the SGE deliveries from China, and a massive increase here, almost double the average of the previous years. So that looks very good for gold. Silver SLV still moving lower. Also PSLV is going lower. So not a lot of interest in silver at this time. Also in China, inventories keep dropping. Not a lot of interest in silver as well. COMEX, silver also trending down. So yeah, we need to see a pivot coming there. We have not seen the pivot yet. US Mint sales up a bit in January. That's good. Premiums, yeah, silver premiums are not that great. They're very low. That means that there could be downside risk for silver. Same with junk silver, which is a proxy for demand, very low. So if this rises again, then silver could drop to 20. I would not be in silver miners at this time. If this drops below 20, then a lot of silver miners are in trouble. They typically have costs around 22, 24. So they are loss making. I would avoid them. SGE premiums for Shanghai are still high at above 2%. So each time that we have these kind of premiums, then we have a bottom. So this should be a bottom in gold. I expect this to go higher to 2,200 in the coming months. Actually, for silver, it's also pretty high, 10% silver premium. So this contradicts a bit the APMEX silver premiums in the West. Not sure which one I need to follow, but I would take gold instead of silver at this moment. If you don't know which one to choose gold. PSLV premiums still in the negative, not good. COT report is actually looking good. So here we have some short covering, swaps going more positive, which means this could be a bottom. So a bottom is starting to form for gold. Open interest is a bit low, so yeah, this could also mean that nobody likes gold. So at some point it will start to move back up and then gold would go higher. Lease rates. I'm actually worried a bit about lease rates. Typically we want to see high lease rates, but this is lower than usual. So in the short term, if this goes up, we could see a bit of downside in gold. For silver, the same. It's a bit low. Swiss franc has dropped a bit. TIPS also dropped a bit. Here, real yields are starting to move higher, but we are not in a positive yet. So this needs to go positive first. Seasonality is not looking that great for gold now because February is typically a topping pattern. So yeah, I think gold could have some downside seasonally speaking until March. Especially today we are at Chinese New Year, so there could be downside volatility. Overall, gold is looking better than stocks, I would think. So the long-term trend is still up. Here as well, 30 to 10-year ratio for bonds. This looks like a bottoming pattern, so gold should move higher. Debt to GDP is also going up. As you can see here, we have an outlook for debt to GDP to double in the coming decade. So that is typically correlated with a higher gold price. So here, if it goes down, this goes down. Then we have debt going up. So up, and then back down. Here we see up, that up and down. So up and down, and then now we have 2008 crisis where that skyrocketed, gold went up, and now this is the outlook. So I would expect gold to slowly move higher, 2,500, 3,000, if this scenario falls out. The near-term forward spread is still in the negative, so we are still at this point here. Gold should move up if this reverts back to the positive. So it's all looking good in the long term. Rate hikes are still going to happen by the end of this year, which is also positive for gold. The proxy for Fed's funds rate was going down. I think it's somewhere here now. So if this keeps dropping lower, then the rate cuts will start to happen. So the trend looks good. As for the 2-year yield, yeah, this is not that good. We should see the 2-year yield go down, not up. So this could be a blocker for gold. We could see higher rates for longer. Here as well, 2-year yield has moved up a bit, but yeah, the trend is still down. So let's watch this. I think it's because the economy is doing better than usual, than predicted. So we could see higher yields for longer, which is not good for gold. Foreign gold deposits still at the same level. They didn't buy gold this month. Let's see how that happens. Bank term funding program, I think there are still problems in the banking system, as you can see here. Many regional banks are failing. That's good for gold. And as you can see here, cash is pretty low. So let's see what happens in March when liquidity goes away. Okay, so that was the status on gold. Long-term goods, short-term volatility. Let's take a look at the central bank balance sheets. Do we have an update here? Central banks are still in QT mode, reducing the balance sheet, as you can see here. This should go back up in order for gold to go up. Money supply pretty stable, actually moving up again. Yeah, money supply is starting to move back up. That's good for gold. Yeah, doesn't look too bad. Deficits. Let's see what happens here. We still have budget deficits. The trade deficit has improved a bit, pretty flat. And we actually see that the services surplus is increasing. So the US is doing really well in services. Probably those magnificent 5 companies that are doing well. On the manufacturing side, it's not doing that well. So here we still have deficits on the goods balance. This very important chart, we see that the price difference is going to the negative. So the export price minus import price is going negative. So this means that we will probably see more deficits going forward. This is a leading indicator and has topped out and now in the negative. So I expect deficits to go up in the US. And this is, okay, I haven't looked at this yet. This looks amazing. Import prices have shot up in December, while export prices are the same. This tells me that deficits are going to increase because import prices are up. Yeah, keep this chart in mind. I think deficits are definitely going up. Exports lower, import the same, okay. Yeah, that's Q4. And as you know, when the deficits go up, so I think this red chart here will go down. At some point, this is going to top out here and then start moving lower. If that happens, then the dollar will also move lower because they are correlated. More deficits is lower dollar. So yeah, I expect this to top out, which is good for gold and also for stocks. Inflation, do we still have inflation? Important for gold. We need to be in an inflationary cycle. And as you can see here, yeah, the 10-year break-even inflation rate is still elevated. So we are not in deflation yet. That's good for gold. Capacity utilization, leading indicator for inflation, is pretty flat at 78%. Okay. So inflation is going to be pretty strong still. It's not like we're crashing to 60% capacity. So inflation will be elevated. That's good for gold. On to some blog posts. So we did see copper treatment charges go down. That means that the smelters are desperate to get copper concentrate. I think that copper is going to go into deficits this year. So I guess copper is going to be a pretty interesting commodity to own going forward. And actually all commodities, because you can see here that it's the time still to buy commodities and sell technology. I mean, these tech stocks are at PEs of 20, 30, and they think that they can grow 20% per year. I think that's a pretty dangerous assumption. We'll see what happens, but I think this is overvalued and we should be buying commodities at this time. I already talked about China gold demand, but here you can see the gold price as well. Whenever gold goes down, the Chinese start buying. The same here, gold down, then they start buying. And now at this top here, you would think that they would stop buying at this price, but it's making almost all-time highs in demand. So you could actually say that this point here is the bottom, same as this point here is the bottom in gold. And we should move much higher from here. So this is why I still like gold and gold miners. Gold miners are pretty cheap. And here is a list of cheap gold miners. If you want to have leverage to the gold price, take the ones with high leverage to this side, and you have the difference, the normal leverage if costs stay the same, and we have the leverage inflation adjusted when you take into account that the costs go up with the inflation. Soma Gold, very good. Argonaut Gold, yeah, they have a bit of operational problems. Monument Mining is pretty good. Serabi Gold, yeah, is also good if gold goes up, but they are a bit high cost. Aura Minerals, very good. Step Gold still needs to do an acquisition, but looks good to move higher. So plenty of things to buy here. These ones are to avoid because they don't have leverage. So conclusion is, I think February is typically not that good for gold, so there could be some downside risk, but in the long run, and let's take a 25-year chart, this is just going to move higher. So if you're not a trader, just keep buying. This is going to go up. And that was the video for this month, and I'll see you in the next video. Bye.